There's a moment I keep coming back to. Silver was climbing. Everyone around me could see it. The charts, the headlines, the group chats lighting up. And I knew things. I had actually studied this. I had sat in finance lectures, talked to professors after class, done real trading exercises where real money moved. I wasn't some guy who stumbled onto a Reddit thread at midnight. I understood how markets work, how emotion corrupts a position, how the exit strategy is everything, and I watched it climb. And I thought, just a little more, just let it go a little higher. Then I'll exit. I didn't exit. And the thing that stays with me, the thing I still haven't fully made peace with, isn't the loss. It's the fact that I knew. Every single thing I needed to know to make the right decision was already in my head. The diversification rule, the exit discipline, the warning signs, all of it was there. And none of it mattered in that moment because something else was running the show, something quieter and much more powerful than knowledge. That's what this video is about, not how to get smarter about money. You're probably already smart enough. This is about why smart is almost never the thing that saves you. There's a story we tell ourselves about financial failure. It goes something like this. People who make bad money decisions just don't know enough. They didn't study. They didn't read the right books. They didn't have access to the right information. And if we could just educate people better, fix the financial literacy gap, teach compound interest in high school, then the problem goes away. It's a clean story. It's also almost completely wrong. Here's what actually happens. Studies from behavioral economics, particularly the work that came out of researchers like Daniel Kahneman and his colleagues, consistently show that financial education has a surprisingly small effect on financial outcomes. One major analysis looked at over 200 studies on financial literacy interventions, and it found that education explained only about 0.1% of the variation in people's financial behavior. 0.1. That's not nothing, but it's also nearly nothing. Meanwhile, the people making the most catastrophic financial decisions in history have often been the most educated people in the room. Long-term capital management, the hedge fund that nearly collapsed the global financial system in 1998, was run by two Nobel Prize winners in economics. These weren't people who didn't understand risk. They had literally written the academic papers on risk. And they still blew up $4 billion in about 4 months. So if knowledge doesn't protect you, what does? And, more importantly, what's actually going wrong? Let me introduce you to a concept that I think explains more about financial failure than almost anything else. It's called the intelligence trap, and it works like this. The same mental horsepower that makes someone good at their job. Good at analyzing, reasoning, constructing arguments, solving complex problems. That same horsepower can be turned against them when they're making financial decisions. Because intelligence doesn't just help you find the right answer. It also helps you construct a very convincing justification for the wrong one. Psychologists call this motivated reasoning. It's when your brain uses its full analytical capability not to find the truth, but to defend a conclusion it has already emotionally arrived at. And the smarter you are, the better you are at it. Think about what happened to me with silver. I had already emotionally decided I wasn't going to sell yet. The greed was running. The excitement was real. And my brain, which might be reasonably good at constructing arguments, went to work justifying that decision. It will probably recover. The macro picture still supports this. I'll exit at the next resistance level. Every single one of those thoughts felt rational in the moment. They were all dressed up in the language of analysis, but they were serving a decision I had already made with my gut. This is not a flaw in a few people. This is architecture. This is how the human brain works. And if you're someone who has spent years building your analytical skills, in university, in your career, in self-study, you've actually built a more powerful engine for this exact kind of self-deception. Your rationalizations are better. Your justifications are more sophisticated. Your story sounds more convincing to you and to everyone else. Now let's talk about the specific traps, because there are a few that show up over and over again, particularly in people who should know better. The first is overconfidence. And I want to be careful here, because overconfidence gets talked about so much it started to sound like a cliche. But the research on this is genuinely unsettling. In study after study, when investors are asked to predict market movements and then rate their confidence in those predictions, the people who are most confident are not more accurate. In some cases, they're less accurate. But here's the part that matters. They trade more. They hold longer. They concentrate more of their portfolio in single positions. And they do worse. There's a famous finding in investment research where a group of fund managers were tracked over 25 years. The ones who traded most actively, presumably the most confident in their own judgment, underperformed. A simple index fund by an average of 1.5% per year. 1.5% doesn't sound like much. But 1.5% annually over 25 years on a portfolio of, say, $100,000 is the difference between ending up with about $340,000 versus ending up with about $500,000. $160,000 of lost wealth from being too confident. The cruel irony is that confidence feels like competence. It feels like decisiveness. It feels like what people who are good at things are supposed to feel. And so educated, high-achieving people fall into it harder than most because their whole identity is built around being capable. The second trap is what I'd call complexity bias. And this one is particularly dangerous for people who love learning. Complexity bias is the tendency to believe that a more sophisticated solution is a better solution, that if something feels complicated and hard to understand, it must be more powerful than something simple and boring, that the real edge in investing, the thing that separates the smart people from the crowd, must be something intricate, something most people don't know about. I've seen this in people who spend months building elaborate spreadsheets to time the market, in people who chase obscure alternative assets because index funds feel too obvious, too available to everyone, in people who layer strategy on top of strategy until their financial plan looks like a hedge fund pitch deck, and then, inevitably, freeze when they can't decide which of their 17 moving parts to adjust first. Here's the thing about complexity. It feels like control. When you're anxious about money, and most people are, underneath everything, complexity gives you something to do with that anxiety. You can research, you can optimize, you can endlessly refine. And all of that activity feels like you're doing something meaningful. But very often, you're just staying busy inside a maze of your own construction. The boring truth, which boring people have been saying for decades and which keeps turning out to be correct, is that the simplest strategies usually win in most of the cases. A regular investment into a diversified index fund. Spending less than you earn, not touching the money. That's it. That's the strategy that beats the vast majority of active approaches over a 20-year period. And it requires almost zero intelligence to execute, which is exactly why intelligent people find it so unsatisfying. And then there's the third trap, the one nobody talks about because it's the most uncomfortable. I'd call it the knowing, doing gap. This is where I live, honestly. This is the version of the problem I see most clearly in myself and in people around me. It's not that you don't know what to do. You know exactly what to do. You've read the books. You've watched the videos. You understand diversification and rupee cost averaging, and not putting everything in one asset class, and having a clear exit before you enter a position. You know all of it. And then something happens. A market moves, a conversation happens, a group chat starts buzzing, and the knowing and the doing just separate. There's a gap between them that's not filled by more information. It's filled by something else entirely. That something else is emotional regulation. And I'd argue it's the most important financial skill that almost nobody teaches. Here's what I mean. When markets move fast, when silver is spiking and everyone around you is talking about it, your nervous system responds. Cortisol, adrenaline, the whole cocktail. Your body is in a mild version of the same state it enters when you're being chased. And in that state, the part of your brain responsible for long-term planning, consequence evaluation, and calm judgment gets quieter. The emotional, pattern-seeking, reward-chasing parts get louder. This is not a personality flaw. This is biology. But it means that when the moment of decision arrives, the exact moment when your knowledge should matter most, your body is actively working against your ability to use it. And the people who understand this, the ones who have developed what I genuinely call emotional intelligence as a financial skill, not just a soft skill, those are the people who tend to do well over time. Not because they know more, but because they've built systems and habits that protect them from their own worst moments. So what does that actually look like in practice? It starts with something almost insultingly simple. Write the decision down before you make it, not after, before. Before you buy anything, before you put money into anything. Write down the specific reason you're doing it, the specific condition under which you will exit, and the specific amount you're willing to lose before you reassess. Then put it somewhere you have to physically see before you can make any changes. This sounds trivial. It is not trivial. What it does is force your rational mind to make the decision before your emotional mind gets involved. It creates a record of your reasoning that you then have to actively contradict if you want to deviate. And that friction, that tiny moment of pause, might be enough to stop the worst decisions. The second thing, and this one took me a long time to actually believe, is to be suspicious of any investment idea that excites you. Not every exciting idea is bad, but excitement is a signal worth examining. Because excitement often means FOMO is present. It means social pressure is present. It means you're probably already emotionally committed to a conclusion and your brain is in justification mode. The best financial decisions I've ever made were, frankly, a little boring. They didn't make for good stories. There was no rush. There was no feeling of catching something before it was too late. There was just a quiet, slightly tedious process of moving money to where it made sense, and then not thinking about it for a long time. The third thing, and this is perhaps the most psychologically useful reframe I've come across, is to stop treating knowledge and behavior as the same thing. They are not. You can know something completely and still not do it. This is true in fitness, in diet, in relationships, and it is absolutely true in finance. Knowing is a starting point. It is not an arrival. What sits between knowing and doing is practice. Repetition. Small decisions made consistently over time. Not one perfect choice under pressure, but 100 quiet choices that gradually become habit. Your SIP that runs automatically every month doesn't ask how you're feeling. It doesn't wait for conditions to feel right. It doesn't freeze. It just goes. And over time, that mechanical, boring discipline outperforms the brilliant one-time insight more often than most people are willing to admit. If I'm being honest, and I think that's the only point of a conversation like this, the thing I've had to accept is that I will probably always feel the pull. The market will move. The opportunity will seem real. The numbers will look compelling, and something inside me will want to act on it. That impulse doesn't go away just because I've been burned by it. It doesn't vanish because I've read about it. What changes is what I do with that feeling. And I think that's the real shift, not from being emotional to being robotic, not from caring to not caring, but from treating emotions as the decision to treating them as information. Something to notice, examine briefly, and then consciously decide whether to act on. For most of us, it requires years of practice and more than a few painful reminders. But it is learnable. And maybe more importantly, it's what actually separates the people who get better at this over time from the ones who keep repeating the same expensive patterns. You don't need a higher IQ to make better financial decisions. You almost certainly already have enough intelligence. What you need is a different relationship with the moment right before you act. That uncomfortable, exciting, slightly desperate moment where everything feels urgent and the opportunity seems like it's about to close. Pause there, just for a second. Ask yourself, am I deciding this? Or am I feeling this? That question alone has probably saved more money than any investment strategy I've ever come across. You're going to make financial mistakes. So am I. So will every person watching this, regardless of their education, their income, or how many finance books are on their shelf. That's not pessimism. That's just the honest reality of being a person who has to make decisions under uncertainty, with emotions, in a world that is very good at manufacturing urgency. What I'd ask you to take from this isn't a checklist. It isn't 10 rules to tape to your wall. It's something quieter than that. It's the understanding that knowing things was never the whole answer. That being smart is genuinely useful and also genuinely insufficient on its own. And that the next time you feel absolutely certain about a financial decision, certain enough that the idea of waiting feels almost painful, that certainty itself is worth examining. Not because you're wrong, maybe you're right, but because that feeling has a name, and that name isn't confidence, it's emotion. And emotion, in finance, is the one variable that often never shows up on the chart. Give yourself the grace to be someone who knows things and still struggles. That's not a failure. That's the most accurate description of every financially literate human being who has ever lived. The goal isn't perfection. It never was. The goal is to get slightly better at catching yourself, one uncomfortable pause at a time. I'll see you in the next one, And when I do, maybe we'll both have paused a little more than we did today.